Hello, this is Susan Salas. Thank you for coming back to my channel and checking out my vlog. I realized that my last video about LLCs primarily was cut off at the end. It said that it was a 19 or 18 minute video and it only lasted like 16 minutes and cut off kind of abruptly. So I apologize for that and decided to follow up with videos on those entities that were cut off, namely the S-Corp and the C-Corp. So I'll be doing a dedicated video for the S-Corp and for the C-Corp, just so you kind of have an idea of when you should choose to use an S-Corp or a C-Corp. Most of the time, you know, LLCs are suggested just because they're so effortless, and there are so many interesting ways you can use them, as I mentioned in my last video. S-Corps have a lot more, you know, regimented things. Namely, you have to have your board of directors, and you have to have an annual meeting with those boards of directors. There are other requirements too, which I'll go into in a minute. But S-Corps and C-Corps have been the entity, the legal fiction that most older organizations are. LLCs just really came of age in the 90s, like 20 years ago. And in Michigan, that's, you know, it was 1992 or 94 that, you know, they started to use them, allow them here, Michigan. And, you know, since then they've, or 93, since then they have become, you know, everybody's favorite just because of their ease of utility. However, what I didn't really get to with the last video was S-Corps. Now, just so you understand, these are designations by the Internal Revenue Service. So really what they are tax shelters. And that's really what a business is. They call it a legal fiction because it's more than just the IRS. It's, you know, other areas of the state agency get involved. So it's on a lot of different levels. But really what it is a way to make sure that you aren't taxed on things in a business that you would be taxed on if it was just your own. So things like long-term capital assets that can depreciate or appreciate over time. There's a specific way to deal with that by, you know, sheltering it in a tax entity. That's really what I went to law school for, was to help artists really keep their money. And for the most part, artists do keep their money simply by not formulating a business. So they end up doing things just under the table and doing things their own way, which is good too, but there comes a time if you really do want to be a career artist and you want to really, or anything, I mean, like be a career yoga teacher, or, you know, a career, and again with a career salsa maker or jewelry maker or whatever, those are things that you do want to, I always think you want to protect yourself in your own home so that you don't lose anything. If you're a yoga teacher and suddenly somebody, you know, has an injured disc, they're going to blame it on you. And, you know, if somebody swallows an olive pit from, you know, this new green olive salsa that you made, you know, you don't want to take these chances, or stabs themselves and gets infected and then they have TB and they have to have an amputation because of your jewelry. You know, these are things that I know it sounds like it's far-fetched, but that's really what I see. That's all I know. And what, you know, the rest of the world sees is totally different, but that's, you know, it really is kind of like the basis of what I do. It's just so much better to be safe than sorry. If all you have to do is file something with the state and then keep up with that filing once a year, it's not a big deal. You know, that ounce of prevention is worth so much more than a pound of cure. I've been sick. so I'm very dehydrated. At any rate, I'm going to try to edit that out, but I think my editing skills have a little bit to be desired still. At any rate, so an S corporation is what I'm really talking about today, and it is an IRS designation, and you can find it in the Internal Revenue Code section 1361, and that's actually at sequitur, so it's 1361 through 1379. It's shorter than the C-Corp sections. The C-Corp, let me think, they're 301 to 395, so that's 95 sections technically, whereas the S-Corp has 61 to 79. It's 1361 to 1379. It's not very big, but those are very imperative sections, and I don't suggest anybody to go out and read that themselves. It would not only be boring, it would just not really be that useful, because you don't know how to apply it. Unfortunately, it applies with other sections of the code and with other local rules that you just end up thinking that you know something when technically you just kind of really don't, and it can get you into trouble. Like I said in my last video, just spend the $500 or the $1,500 or whatever to get an attorney to do it, and ask them to give you a letter about what they did or why they chose to do that, or why what the options are for you to make the choice. And that way you do have an idea of what exactly is involved in this specific thing. I don't think any lawyers are really adverse to, giving their clients an in to what is happening with that level of their own business. So, at any rate, it is designated by the Internal Revenue Service, and what you want to do is follow the limitations. Now, you can have up to 100 shareholders with an S-Corp. So, for instance, GM, the big three, General Motors, Ford, and Chrysler, are not S-Corps. And you can figure that out because they are publicly held corporations, and they have, obviously, more than 100 shareholders. They have thousands, if not millions, of shareholders all over the world, and they have probably had multiple listings of sales of shares over the years to encourage revenue in order to expand the business. So it's kind of like a weird catch-22 where a company like that can offer international sales potentially of their shares, and as a means of further expanding into that region. So say they offer their sales of shares in China or India or Mexico, and in the U.S., of course, or wherever, and or say with NAFTA, Canada, U.S., and Mexico, and say it's under some weird arrangement or a treaty, or NAFTA, and so they first get the money from there in order to expand there. And then those investors will see the return on their own income by working there, by contributing, to the growth of that economy, essentially. And that's how capitalism has taken over the world. So you can only have 100 shareholders in an S-Corp, though. So as you can see, the General Motors of the world are presumably C-Corps. But like the Beyoncés of the world are presumably S-Corps. If she has more than 100 shareholders, yeah, that would be pretty funny. I mean, it's just like doesn't really happen. It must be individuals, unlike LLCs where anything can own an LLC. It has to be owned by, an S-Corp has to be owned by individuals, and there are exceptions though. A nonprofit organization under 501c3, which is also the IRS designation 501c3, can be a shareholder. So you could have an S-Corp that is owned by nonprofits. It's pretty interesting. Like, if you really think about, I don't know, there's a lot of really interested young people in their 20s just now coming out into the world of entrepreneurship, and they are really fascinated by this kind of stuff, and I am too. This is the kind of thing that is it's very interesting, not just to think about, but to actually put into action. You could have you could set up it just seems backwards. I think most people think for-profit first, and then you'd reach out to like the, you know, music in schools program or whatever that Justin Timberlake did. You could actually have, you know, the YMCA or a leg of the YMCA could be a shareholder on, you know, some for-profit group, and it's not, it doesn't mean that they, you know, those distributions would still be tax exempt to them. So it can be interesting. It's convoluted, but it's convoluted to like a narrower way of thinking. But at any rate, non-resident aliens. They still use the term aliens in the Internal Revenue Code. So like someone who, you know, who's in Canada or Mexico, who doesn't live in the United States, cannot be a shareholder of a local company, of a U.S. company. It actually has to be residents. They have to have a residence here. So they have to have, you know, their visa and their green card and all of that stuff, or be a naturalized citizen. But they can't live somewhere else. But, you know, of course, expats from the United States who now live overseas or wherever, they can still, you know, have their, be a shareholder in an S-Corp. But it's still interesting intricacies. The reason why I'm going so deep into it is because if any of these strictures are violated or breached, the status of your company automatically reverts to a C-Corp. And it just incurs outrageous tax liability. C-Corp is not the favored choice for businesses for a lot of different reasons, but the primary one is that it's dually taxed. It's taxed on the company's profits, and then again on the individual's profits, the owner's profits. So instead of being taxed once at 35%, it's taxed like twice at 35%, and the owners get, you know, nothing. They get 33% take home, and that's it. So it just ends up being, but of course there's balance, and you know, it's a different exploration, which I hope to go into in my next video. But so what you don't want with your little 100-person company, or, you know, 100-person owner company, is for it to revert to a C-Corp. And then what's more is, just because you have somebody, you know, on your who owns, I was going to say on your board, but who is an owner or a shareholder who shouldn't be, and then you won't be able to revert back to S-Corp for another 5 years. You'll be penalized. So not only will you go back to the date that the violation occurred, so if it happened in 1987, you're going to have to pay taxes like a C-Corp back to 1987, plus interest and penalties, and then you can't even become an S-Corp again for another 5 years. So it ends up just being a disaster, and you just want to make sure to know that those things are in place. But additionally, of course, you also want to have your board of directors, which is what I touched upon in my prior video. You want to have a board of directors, and you want to make sure to have your annual meeting. The board of directors, and if there are investors who have invested money to help you start up, then they automatically are on the board of directors. And they do meet with you, you know, at least once a year to identify the path of the company, the growth and the direction of the company. So, you know, it can be really intense, but not really, because if you are that serious about it, you do have investors, and a lot of people do. There's a, you know, from, I don't know, that Kickstarter or crowdfunding, most people haven't done that yet, and this is probably the reason why. If you own, you know, somebody donates $10 or pledges $10 to help you, do they get a share of your company? Not yet. Usually they get like a water bottle or a pen, but they don't usually get a share. And this is part of the reason why, because you don't want to have all of these people who liked your idea to suddenly have a say in who gets hired and fired and, you know, the direction of the company. No, we're not going to expand into a different city, or yes, we are going to expand into a different city. You know, it's, you know, that's what the board does. But when you're dealing with larger companies where you have 50,000 or more in investor capital, initial investment capital, that person or company sits on the board, and there's no limitation on the board. It can be a company, a 501c3, it can be anybody. But so that's interesting. But as far as being a shareholder now, so you do have to designate between ownership and investors. So if you do have the alien investor, and like I said, I am just using that term because that's what they use in the Internal Revenue Service, Internal Revenue Code. But if you have, a foreign person, and now that sounds funny, but anyway, if you have an alien investor, then they really can remain only an investor, and they don't have to be a shareholder who gets distributions every year or every quarter or whatever. But instead, they can remain solely an investor who gets paid upfront with interest. Distributions to shareholders and owners comes only when there's a profit. But that is actually the second most important point after all of what I just said, being the first point. Now we are at the second point, and that is that an S-Corp is taxed only once, but it's taxed on its profits only once. It has passed through taxation, which means, long way of saying it, which means it's not just the profits, but also the losses that are passed on to only the shareholders. The company doesn't necessarily have to deal with those losses. So what that means, it's a little bit convoluted, but it is actually, again, really interesting. And what it means is that for every $3 that a company loses, the owner will still get $1. It's not like a total loss, just based on the formation of a company where you have 35% tax base. That's how much the IRS takes, and in the case of losses, that's how much you keep. And it can also be passed through to whatever other businesses that shareholder has, on the side or instead of, or whatever. That loss can actually turn into an asset by helping that individual who is getting the pass-through taxation. That pass-through loss, it's balanced out on their personal income tax as opposed to the business income tax. Which leads to another interesting point, and that, again, that differentiates with LLCs. S-Corp and a C-Corp, they have continuity of life. So what that means is that even if you do have losses, your company can still continue. An LLC, your company can still continue too, but where an S-Corp continues that an LLC doesn't is if the members die. The original founders of GM are all dead, and GM, General Motors, still continues. Law Office of Susan Salas, it's a professional LLC, PLLC, and when I die, my law office dies. So for the most part, other LLCs, unless they convert to an S-Corp or a C-Corp, that entity will effectively die, unless you have many members, and you have also, it helps if you have some kind of terms of dissolution, whether it dissolves when one person declares bankruptcy, one person dies, does their estate get it, does their spouse get it, do their children get it. You can designate that kind of thing, again, with contracts or agreements. But an S-Corp, it automatically continues. And it's just a matter of, what happens to that ownership interest. Because there is that continuity of life, the transferability of that ownership interest is great. The transferability of an LLC is not. They tend to be very limited, very local. They're not, just really large businesses that people want to own, unless, it's, a really reputable mechanic shop or tattoo parlor or whatever. In this area, it's not something that people are going to be like, yeah, I definitely want to buy Eternal Tattoos. Some people do, but in the case of General Motors, there's a lot of people who do. The transferability option is vast and it's quick. You can sell it. I could sell it in 5 minutes right now at 10 o'clock at night. It's just, that's how easy that is with that large of a company and that designation of ownership. But An LLC is different. So the next video that I do, however, I'm trying to think if there's anything else. I think I did miss something, and that dealt with the classes of stock. But the next video that I do, just to finish my sentence, and it's going to be a C-Corp, and while I did everything comparing it to the LLC, I will compare a C-Corp to the S-Corp and to the LLC as well. And I might go into a little bit more detail regarding partnerships, sole proprietorships, doing business as, just to kind of get an idea of what you really have at your disposal, and what some of the benefits are of them each, and you know, how to maximize your dollars. Now, of course, like I said, LLCs are a sweetheart. They're super easy in a lot of different ways, but the dollar maximization there comes with, you know, complex holdings formation. Here, it comes with, you know, your stock, with the basic continuity, the transferability. Like, there's just kind of a different essence of what the S-Corp offers in terms of what makes it a desirable option for your entity. But again, that's something that you do want to talk with a business lawyer or professional about, maybe an accountant, just to get an idea of, you know, who's starting it, how many people there are, how dedicated they are, where the money is coming from to start it up. Money and sweat equity, of course, like who's going to be working, who's going to have designation as a key executive employee, who's the president of the company as opposed to the vice president. And then on the board, I might have mentioned something in the last video also about having at least 3 people on the board of directors, namely the president, the secretary, and the treasurer. Vice president isn't as important as those 3 key positions, because the treasurer keeps the money, the secretary keeps the notes, and the president calls to order. You know, the president chairs the whole thing. The difference between a president and an executive chair is that a president is usually not paid. An executive chair is, or executive director of a board, is usually paid. It's usually a salaried position, and the board itself needs someone to work 40 hours on the board. It's usually a huge company that requires that. I can think of like nonprofits, United Way. I think the United Way executive director, he earns like $500,000 a year, and I think that was a pretty large scandal a few years ago, a couple decades ago maybe. But anyway, but having different classes of stock, that's the last point, and that is you can only have one class of stock in an S-Corp. That class of stock, you can designate, there's no preference to distributions. There's only a preference to voting rights. So you can say that the first class, Class A preferred stock, gets to vote on, you know, who the board is, in addition to, you know, A, B, and C. And Class B common stock can only vote on A, B, and C, but they don't get to designate the board, or vice versa, where they can only vote on the board, but they can't vote on all these other smaller issues. But so you can designate, even though there's only one class of stock, you can designate specific voting rights. But distributions, everybody has to get paid the same, except for investors, who always get paid first. So in order to repay your debts, so that you can start building equity in the company instead of, you know, being just an indebted organization. So, okay, I'm sorry that it was so rambly, and I hope that you were able to get some information out of it. I'm going to see if I can cut it down, because 25 minutes is a really long time. But please feel free to leave comments below or ask questions. And I do want to disclaim once again that this is just for Michigan companies. You know, it's information for all, but I really only know Michigan companies. So, and I can really only market my law office as being eligible for hire to Michigan constituents. But please feel free to send me a question or leave a comment below. I appreciate your time. Thank you. Bye.